Hey there again. Okay, video number 24, but for module 2 it's going to be video number 8. And in this video we're going to talk about the Bollinger Bands. Alright, let's take you back to the trading station again. Alright, let's remove some of the junk on this chart. And the way we can do that is right click, choose indicators list, and then we can remove the indicators by highlighting them, pressing delete, and then close. Alright, just put on the auto scroll. Okay, so as before, navigate a list and twirl open your indicators, and what we're looking for here is the Bollinger Bands. And go ahead, right click, left click, drag and drop, and you'll have some parameter settings that you'll need to adjust. Now the period you can leave as it is, the deviations too you can leave it as it is. We've got a medium sea green here. Well, what I'm going to do is I'm going to just choose black, okay, and I'm going to choose a larger thickness as well so we can see the lines better, and I'm going to click on OK. Alright, so so let's see where let's minimize this window a little bit so we can see some more information. Alright, now the Bollinger Bands basically takes a measurement of the volatility previously and then applies the volatility kind of information ahead. So when you see a lot of movement in the market, like you say if it's going up, you'll start seeing the top band, which is here, and the bottom band, which is here, getting further and further apart from each other. And then as the market starts to become diluted and there's not really much going on, the volume in the market starts to drop, and when it starts to drop you'll start seeing the top and the bottom bands getting smaller and smaller to a point it gets to, it's like a bottleneck. It's like you're squeezing the top of the bottle to prevent all the water or the beer coming out of it. As soon as you let go it bursts, and then boom, and there you go. So here we can see here like the pressure is being applied, it's being squeezed together, and eventually it needs to break out one way or the other. Normally the general rule of thumb is that the first indicator to break out, either the top or the bottom, will dictate where it's going to go. Alright, let's give you another example. Like for instance, we can see that as the market's gone up, we can see now the bands are moving further away from each other, but as the market is starting to become smaller in volume, the bands start to get smaller and get close together. And then at the point of the breakout, the top part of the Bollinger Band here and down the bottom, you can see this bar breaks the bottom, and therefore it dictates the rest of the trend. Then you can see again it's starting to the bands are getting closer together. The top band and the bottom band are getting closer together, and then we can see the breakout of this candle here, which will dictate that this is now the direction that we should be going in, which is long. Alright. Also as well, a good indication when to get out is actually the third break. Let's say we're going short and we want to work out where we want to get out of this trade. The best way to do that is calculate 3 instances where the candles have actually broken below the bottom of the Bollinger Band. So here is the first instance, here is another instance right there, and here's another instance right here. So we can get out around about there, but as we've taken note before, as the Bollinger Bands get closer together and when it breaks out again, it will dictate where to go. So you can basically stay in there. So 1, 2, stay in, 3. So right there I'll actually get out and close a trade. Alright. Here is we've got 1, 2, 3 peaks, and then it tells you when to get out. Alright, as if we're coming in for short, we can just barely see. There's a little break there, and there's a little break there, and there's a little break there to tell us when to get out. Alright, and then if we wanted to go long, we take the first candle of the break of the top, and then we count 3. So 1, 2, 3 tells us to get out right there, and then the Bollinger Bands kind of get close together. Then there's a break right here. So and we have 1, 2, 3. We have 3 piercing out. You can just see it right there, and it tells us to get out around about there. Alright. Another way that we can actually use the Bollinger Bands is to really wait for the Bollinger Bands to be hit at the bottom, and then take the break of the middle Bollinger Band, and then take the third exit of the bar, like when it pierces above. So it is bar number 1, here's bar number 2, here's bar number 3, and we close out right here. Alright, and then we can see that the Bollinger Bands are being hit by the candle, and then there's the candle here that actually breaks the middle of the Bollinger Band, and then we can go short on the next bar. Now it's important that the body really does break the middle of the Bollinger Band. You don't really want it to have the tail or the wick to break it. You really need the body to break it. Like this is the instance here when the market came down, it came below the Bollinger Bands. It didn't really get to that point where it hit that bottom of that Bollinger Band, but it's close enough, so it's still okay. And then we basically went long on the next candle on this bar here. So here is our confirmation, and the top part of the body here actually closes above this middle part of the Bollinger Band. Alright, and then we get out on the third peak of the candlestick, which is that green bar right there. So the same thing again for when we want to look for a short trade, is we want to see it penetrate through the bottom here, and then make sure that the next candle is also below, and then go short. And here we are, we're going short, and we're waiting for 1, 2, 3. 3 bars actually penetrate outside of the bottom of the Bollinger Band, and then we'll basically close our trade there, and then we'll wait for another break. Alright, so here we can see that where the bears have actually got tighter, closer together, and then we're looking for the break. This one here is not really a true break because it's still inside the bottleneck, but when it starts to break out to really show some definition in its move, that's your first alert. And then we can see right here it is time to go long here. From the time of the last video to this video was literally about 60 seconds, and we can see now that I've just made like another 40 pips on this trade, so we're 173 pips up on this. Alright, equivalent, it's about 1.7%. It might not mean a lot of money to most people, but when you see my trading style, you'll see hopefully that this bounce will get very big towards the end. Alright, so yeah, you don't really need to trade too aggressively, just trade normal money management, and then you should be okay. Alright, so basically this is how we work with the Bollinger Bands. Alright, we do have other strategies that we can use, like the hammer. And the hammer is basically, as it sounds, the candle looks like a hammer. Alright, and when you see them appear at the bottom, you go long, or when you see like twin peaks, you go long as well. Here is like one kind of like twin peaks when you have 2 candles basically of the same bottom part of the body that equal, then you can go long. And the same thing with a short trade, you're really looking for 2 bars. But we will get into this a little bit more in candlestick formations and how we can use them in conjunction with other indicators as well. Alright, but for the time being I can't really see any. Well, here's a bit of a hammer here that happens right at the bottom, but it's not a perfect one. There's an inverse hammer. But anyways, but yeah, I will leave you with that. So just basically, for the most part, what you would really want to look for is really these areas here where they basically come in together, and then your time to actually get ready to go for the trade is when they start to expand out from each other, and then when the bar breaks one or the other, that will dictate where to go. You can see this one breaks going on the new bar, and then crikey, look, this one just keeps on going up. Alright, when to get out? Well, this bar here actually closes below the middle of the Bollinger Band. You could essentially, from here to there, that's 135 pips. So from there, essentially, you could book in 50 pips and not close the trade and see what happens, to see if it keeps on going up. If you chose that option, Crikey, that's 400 pips in 54 times 4 hours, that's 200 hours. And this one, 70, that's 280 hours. So, that's almost about a week and a half. This trade at the moment we have open, it's been open since the 7th and it's now the 12th. So it's 5 days that this trade has been open plus the weekend. Alright, 180 pips up. Anyway, so I will leave you with that video for the moment, and I will see you very shortly in the next one. Alright, bye for now.